So greetings to everyone and Happy New Year. I hope this year brings us success, growth, and new opportunities. We are excited to kick off 2025 with this impactful trainer section and the building objective of the trainings we have shared last year. So let's join in and make the most effective session together by getting practical knowledge we can apply in our work. So my name is Oluwatobi Okoma, and I sincerely thank each and every one of us for our patience, for taking the time to wait for this video. I truly appreciate your commitment to learning and growth together. So in today's training, we will focus on the critical aspect of IFRS 9, which is financial instruments under expected credit loss, ECL. Yes, this topic is the key to modern financial reporting, also helping organizations manage losses effectively to meet global standardization. So by the end of this training section, we will all get clarity and practical insights that will help us confidently apply ECL principle under IFRS 9. So I encourage us to stay engaged and take notes. So before we start, let's quickly revisit some of the key concepts of financial instruments to refresh our memory from the last class, which is the main topic under financial instruments. We said in the last lectures, we talk about financial instruments themselves and how to identify those items in the financial statements and also the types and classification of financial instruments with practical illustration to be able to identify financial instruments in financial reports. So according to IFRS 9, we said a financial instrument is any contract that creates a financial asset for one party and a financial liability or equity instrument for another party. So we use ourselves and a friend called Mike to illustrate an example for what a financial liability is and also financial assets, and we also define financial equity, that is equity instrument. So in the simple time, it's an engagement that resulted in a party either that receiving money or owing money, receiving end and owing end. That makes what a financial instrument. So we are able to identify receivables, payables, equity as financial instruments and other line items that we can pinpoint in the financial instrument. And also, importantly, we talk about ordinary share capital. We said ordinary share capital have different names. It can be called equity share in UK term. It can also be called common share stock in US term. And the same equity can also be called voting rights or voting share, common equity, and so on. They are all equity share. So let's quickly and briefly go into today's topic, which is ECL. ECL. ECL, that is expected credit loss. Imagine that you are Okpe, have always dreams of starting your own bakery, and after your planning, you finally decided to take a step. And to make this dream a reality, you approach a bank, a local bank, let's say ABC Bank, for a loan. Yes, the bank was impressed with your business plans, business strategy, and they eventually agreed to lend you 2 million naira. And that is after following the due processes. You know, banks have a lot of processes which should be followed because of compliant purposes. So at the first time, you are doing great in that business, a bakery business. So Okwe Ovens was doing very good, and the turnover was really, really impressive. So every month, you are able to pay your loan on time. And ABC Limited that borrowed you this money was very, very happy because you are doing well and you are paying your loan. After a year or two, a new bakery opened nearby, and this slowed down the operation of your business. That is, the revenue generation reduces because of another bakery opening very close to you. So, as at that point, you couldn't make the revenue you should have made to be able to repay your loan. So you started missing some of the loan's payments because the cash inflow was not coming in and it's very, very slow. So under IAS 39, that is the previous standard, IAS 39, ABC Bank will classify your loan into categories based on how well or how able you make payments. That is, they classify loans under standard loan, which means there are no issues with repayment. That is, repayment is being done smoothly. Under IAS 39, ABC Limited will also make a provision for substandard loan, which is 10% on the remaining balance yet to be paid if they observe there is a late payment, but the loan is still ongoing. And when it is observed that you have started missing payments, they go back and reclassify your loan to doubtful loan, which is what, 50% on the remaining balance unpaid. So when missing more payments, now they go back to classify your loan of my bakery to be bad debt. That is 80% of what? Of the remaining payments unpaid. And when the bakery eventually closes down, God forbid, but everybody will forecast we don't know what we can happen, so we have to prepare for the worst. So let's assume the bakery eventually closes down. Then I know you could have had some other plans because diversification could have occurred in between. You could have seen that the going concern of this business might not be going well. So let me diversify. Let me see where I can also fit in. So eventually, let's just assume Okwe Bakery closes down. Under IAS 39, ABC Bank goes back now to classify Okwe's loan as lost loan, which is what? 100% on the remaining balance unpaid by you, which is Okwe. So this processes introduces IAS 39, which is called, by my own words, a reactive approach to loss recognition. Because it is when the loss crystallizes, you will now go back, oh, this has occurred, let me quickly go back and readjust. But if eventually nothing happens, then the thing goes that way. That is, losses are recognized only when there is a clear evidence of a problem. So this example cited is just like driving a car and waiting until the fuel tank is completely empty. You know, you are waiting for the fuel tank to completely empty. That is how IAS 39 operates. No matter the warning, the signal, the bank can't recognize any losses until there is a damage done. reactive approach, focuses on the event, not proactive. So instead of waiting until the fuel tank is empty, you quickly refilled the tank halfway. And this is exactly what IFRS 9 introduced, which supersedes what? IAS 39. So IFRS 9 introduced a proactive approach, which is called expected credit loss, ECL approach. Now requiring financial institutions to estimate their possible losses based on what? Future risk. So by this way, they are not just being reactive to damages after the event has happened, but what? Prepared to handle issues before it crystallizes. So what is ECL under IFRS 9? What is ECL under IFRS 9? Expected credit loss is a way for financial institutions like banks or lenders of money to estimate how much money they might lose if the borrower does not repay the loan they borrowed. Let me repeat that. ECL is a way for financial institutions like banks, lenders of money to estimate how much money they might lose if the borrower does not repay the loan. It is like planning ahead for possible losses. That is, bank has to estimate and record possible losses on this loan being borrowed. Excuse me. Even when the borrowers have not even missed any payments yet. That is what we call proactive measure, looking forward approach, forward-looking approach. So, expected credit loss is not typically challenging the way manufacturing entities or service sectors entity recognize provisions. It doesn't really challenge them because, but they what? They base their changes based on what? Financial institutions, that is banks. They are basically affected by banks. And that is the reason why banks is mentioned often. So when I'm giving you a loan right now, on the first day, the day one, I will recognize ECL. Also known as what? Provision for bad and doubtful debt under IAS 39. The first day I'm giving you a loan, I'm going to recognize what? ECL. In this scenario, bad and doubtful debt is not used. Now expected credit loss under IFRS 9. I'm trying to relate to construct and contrast where we are coming from and where we are now, so that you'll be able to know the difference between where we are coming from and where we are now. You can see now you are no more hearing 50% substandard loss, bad debt, you are going to charge 10% of loss. You are no more hearing that now. It has been eradicated and what? Substituted by IFRS 9, which is ECL. So let's look at credit losses. So what is credit loss in this context of expected credit loss? What is that credit loss we are expecting? Credit loss simply means the loss a company expects to face when its customer fails to pay the money they owe on time. So if company XYZ, my good and loyal customer, fails to pay, what is the loss I'm going to suffer? That is what the loss I'm expecting. If my loyal customer refuses to pay this money, how much am I going to suffer? And that is what the loss I'm expecting. And that is where the name expected credit loss emanated from. So under IFRS 9, expected credit loss are recognized for both on balance sheet and off balance sheet. Let me explain. When we talk of on balance sheet items of expected credit loss, that is actual financial assets that are recorded on the financial statement, in the balance sheet, in the statement of financial positions, such as the loan, the receivables, the investments in bonds, and so on. So the ECL calculated is now based on the amounts currently at risk. That is, the outstanding original amount of money that was what? That was loaned. Let's assume I loaned an entity 2 million naira. That is what? The financial asset that will be reported in what? In my books. And that is what my ECQ is going to base, my ECL is going to base on. The original amount of money that was loaned. Which is what? Already recorded what? On the balance sheet. So let's talk of off balance sheet. Off balance sheet, that's when we talk of off, that is not on the balance sheet. It's my below or balance sheet, but it's not on the balance sheet. So what gives rise to off balance sheet items? Off balance sheet items like financial guarantees, loans, and commitment, as it is on the screen, financial guarantees, loans, and commitment that don't appear on the balance sheet, but could still be what? Costs that the company may what? May incur later. The money what? The company may what? May incur later. Let's say, for example, a bank promises to give you a loan in future. They say, Toby, you come back in the next 2 years. Don't worry, you have a good deed with us. You are a loyal customer. But now we are in financial crisis. Please, can you come back in the next 2 years? I've not collected the money. It is just a promise. They have not handed the fund to me. I've not collected the money. It's a promise that they will give the money in future. So such promises is not recorded in the balance sheet right now, even though what? It is a potential obligation. Because they are what? They have committed themselves already. Whether they like it or not, they have committed themselves. It is not on the balance sheet, but it's what? It is what? It is a foreseeable expense. It is a future expenses, a future loan that will still be collected. And those are the criteria of all balance sheet items. So that is, I promise to give you a loan later in future. That is what we call off balance sheet. But I have collected the loan now. That is what we call on balance sheet, because the figure will be recorded on the balance sheet. So in summary, IFRS 9 makes sure that all risks, whether obvious or hidden, are accounted for, making financial reports more transparent and reflect the true picture of an entity. What do I mean by obvious or hidden? When we talk of obvious, that is on balance sheet. When we talk of hidden, it's off balance sheet because it's not yet crystallizes. The money is not as given, but it's a promise that one day I'm going to give you. You have already committed yourself. Then you have to calculate ECL on it. Let's remember that transparency is one of the objectives of what? Of IFRS. And this is how to ensure transparency is being required in all our dealings under IFRS. So Let's briefly move to other aspects of IFRS 9. Let's briefly move to other aspects of IFRS 9. So how do you calculate ECL for both offline and online balance sheet, since we all know that they are what? Through their definitions. How do we calculate them, online and offline balance sheets? So, as I said the other time, the ECL calculation is the same for both off and online balance sheets. Reason, because both involves predictions, how much money you might lose in future, whether it's existing financial asset or liability that could arise in future one, or what? The method for fighting against, and also what? Whether it's a predicting one. They are all what? They are all financial losses that might happen in the business. So the method for fighting out these losses is the same, whether offline or online. And that's the reason why we have financial commitments, loan guarantees. People will be thinking, but all these things, they are just guaranteed. They've not even given me the money. You are going to, because you are still going to what? To incur the losses. You are still going to what? To borrow. So there is a risk on each borrowing. So let's go ahead. IFRS now requires to be classified into 3 categories as it is on our screen. It's going to be classified into 3 categories on our screen. Let me quickly scroll down. Without expected credit loss, we are going to come here. Let's quickly stay here. Let me quickly explain. It's going to be categorized as 3 stages, on 3 stages. So under the 4 stages of ECQ, most loans here are categorized under the 1st stage. Unless they have already seen that this loan is on a high risk. Unless the company, the banks have already foreseen that this loan I'm giving you is on a high risk. Let's assume a decorating company, a Christmas decorating company, come to obtain a loan. You know that it's only Christmas Day you do Christmas decoration. So if such company is coming for a loan in a bank, you know it's already on a high risk. It doesn't need to go through the first process. It doesn't need to go the first process because what? It's on a high risk. So that is just a definition of how to categorize loans or borrowings. So any other borrowings aside high risk borrowings will fall into what? Into stage 1. So most of these financial assets are initially recognized under stage 1. Reason is that no significant increase in credit loss at that stage, because no borrowers will want to default at the 1st stage. No borrowers. I mean, the initial stage, they will want to impress the lenders. And that is the reason why all loans will be categorized firstly on the 1st stage. Even when the borrower does not have that money, at this stage, you will go and borrow just to impress what? The lender. Yes, they will go and borrow to impress the lenders. Yes. I will not want to mention any tribe here, but I know of one particular tribe. You know, when they are renting houses, they can pay off funds like 4 or 5 years. And then after that, for you to get another fund as a landlord, it will be very, very terrible. So, you know, as at the first stage of renting, it happens to everybody. At the first year, you will want to impress the landlord. You will want to impress the borrower, the lender. So that is the reason why all loans, except you have already identified, hope I'm communicating. As an entity, you gave a loan. As a bank, you gave a loan to your clients. After you have already assessed all the documents, from there you'll be able to pinpoint, this loan, This loan is on the high risk. Looking at the economy, looking at the nature of business in which looking at other similar business in relation to the person borrowing the money, you'll be able to pinpoint, this is a high risk, but I'm going to borrow you, but it's not going to enter into first stage, because this has shown that you might not be able to continue, or you might not be able to pay again. Let's go ahead. Number 2 criteria, as it is on our screen, you can see no significant increase in what? In credit loss. Everybody will want to pay. So on this stage, number 1, all loans will be categorized under first stage, except is on the high risk. And number 2 is that 12 months expected credit loss. At this stage, all loan will be what? Categorized within 12 months. Within 12 months. There is no person, there is no individual that will want to rent a house that will not go with the full amount within that 12 months. No, it's not really. Even if the money is not complete, you go and look for the money and complete it the first day, the first payment. The first payment will be intact, but when the second comes, that's where the issue comes. And that is the reason why it's being categorized within that 12 months that, yes, everything is fine. So I hope this recording, because I have a link here, but I think it records. So let's just continue from where we stop. And if it doesn't record, I'll have to do it in 2 phases, but I'm sure it will continue the recording. All right, so let's look at it at the first stage. Within 12 months, everything will fall within 12 months, because within that 12 months, you know, this person cannot, this individual, this firm cannot default. And that is how to what? To be able, that is how to be able to ascertain how to categorize credit loss. It is subjective in nature. There is no formula. You are the formula of your ECL, because you know your customer more than I do. You know the customer more than I do. You know, there are some set of customers, the way they touch, you will know, they will tell you, this one does not have money. Don't look at the clothes. I know his finances. I have his bank statement. It's not about the clothes. Me, I can be looking at the clothes. This person is a big man. But you that borrows the money, you know the finances. And that is the reason why ECL is judgmental. And it's you as a company that can determine what and what your customer can pay. So within that 12 months, everybody will do what he or she takes to be able to meet up demands. So when a loan is being gotten, it is categorized under stage 1 for 12 months credit loss, and also less significant in credit loss. And number 3, the interest calculated will be on what? On the gross amount, just the way it is. Let's assume we have my client, I lent my client 80,000 naira. So the interest is 6%. Definitely 6% of 80,000 will be what? The interest on the loan. So let's continue under ECL for stage 1. We are able to ascertain that the first stage of ECL, no significant increase in credit loss except is on a high risk. Number 2, loan must not be more than what? 12 months. Because after 12 months, some people what? We want to delay and apply 12 years, at least it's just next year. Some people say knows from their mind. They are not going to pay the loan next year. They know. It's as if they are paying the first, and they say this loan, forget. They will work tired. They will not collect anything from me. They know. And that is the reason why it's being ranged for 12 months. And the interest to be calculated on the gross amount, that is the total amount being lent. So after categorizing all this, then we need to calculate the ECL under the first stage. And that leads us to the formula on calculating ECL. So what is the formula of calculating ECL? Let me quickly go back. What is the formula of calculating ECL, that is the expected credit loss, as it is on our screen? We have the probability of default, which is the PD, multiplied by loss given default, which is the LGD, times multiplied by exposure at default ECD. So let's break down this term. Let's break it down. So what is probability of default? What is probability of default, that is the DPD? Is the chances that the borrower won't pay back the loan. So when you have already looked at the finances, you have looked at it, just like a firm, just like a company dealing with Christmas decorations. You know that this person, for him or her to pay this loan, it will take a longer time, because the inflow doesn't come as well because of the nature of that business. So looking at the finances, looking at the nature of business and other relevant businesses that operate within that scope, you should be able to pinpoint that, no, the probability of default is very high. No, it's very low. Let's look at MTN. Let's compare MTN and a decorating company. Without needing any mathematical or logical calculation, you should be able to know that no, this company, they have irregular inflow, so the probability of default will be low. Decorating company, only Christmas Day. Hey, their probability of default will be high. So you have to fix the percentage in which we choose individual clients. So you are the one to look. This is the probability of default. Going through their finances, a lot of processes, you look at their ratio, the liquidity, the gearing, the nature of business, how they operate, what are the other streams of income, how did they make their profit, how did they diversify, who are their MDs, who are their directors, all these things collect together to determine your probability of default. Then you will now put a percentage. That is the reason why I said it's judgmental. No one can help you calculate your ECL. You know your customer that you do. And that is the reason why there is KYC. Know your customer. All those things, the information will be given. You will also verify to be able to determine the percentage in which you will place on any probability of defaults. That is number one. Let's quickly go under the stage of probability of default. As I've said, you look at their credit models. Let me go back. Please. You look at their credit models. The credit model, the likelihood of default, as I said. Look at the history of borrowings. Are they prone to borrowings? Because when a company is too geared, there is issues. There will be issues of paying. Because when they have a lot of interest to pay on loans, even to finance their own organically will be very difficult. How is their gearing ratio? Look at the ratio analysis. Debt to income, interest to coverage, liquidity ratio, financial health, ability to repay back. Their historical data. Refer to the past default referral, the borrowing, the similar funds they borrowed. What is their profile like? How did they pay? And let us look at the economic situation too. Will the economy permit them to pay? Will the economy permit them to pay? Let's imagine completely into renting of spaces for offices. Now that most of the companies that are not doing work from home, in order to reduce office spaces. So any estate managers or renting of spaces that comes for loan, you need to have known that a lot of people are working from home now. No need of offices. So you'll be able to pinpoint as what? As a bank, as a bank to be able to what? To pinpoint, oh, I'm rating this percentage on this. So these are the criteria in order to be able to know the probability of default of a lender, of a borrower as a lender. So let's briefly look at other things on ECL. So now based on all our judgments, we assume 2% for probability of default in this scenario, because we are going to do the calculation. So we'll use one of the telecommunication companies. We know telecommunication companies is a fast-growing sector. Whether you like it or not, you will make calls. In fact, so we can't even do without data. Even if you don't have money to eat, we will borrow. We have data. So it shows that that kind of sector are not that kind of sector. Their probability of default will be very low, and that's why we are picking 2%. So let's briefly look at the second one, which is the loss given default. The loss given default, that is the LGD, is the percentage of exposures to what? To risk. Exposures at the default. Exposures at the default. Let me call the exposures at the default. That's a term. That is amount at risk. That is, the lender is expected to lose after trying all the recoverables. That is this percentage. It is the one you will lose after you have tried all your means to recover your debts. You have used mopo to carry the borrower. You have using touts to threaten the guy. You have used all sort of diabolical things to threaten the guy. There is no way. This is the percentage you will not be able to recover after using all the medium to get your money back. And that is what we call loss given default. That is the percentage of what? The exposure at default. So let's go ahead to the next one, which is exposure at default itself. So this is the total amount of what? Or balances that could be what? That could be lost. That is, let me assume figures. I borrowed 800 naira. That 800 naira is the full amount of money that will be on the balance sheet. So when we talk of loss given default, that is the percentage after you have paid. Let's assume you have paid from that 800 naira, I've paid 400 naira. So the remaining balance now is exposure at default, right? Because I've paid 400 naira, I've paid 400 naira from 800 naira. The remaining money is what? Exposure to default, right? So that exposure default, and I go and collect mopo, I go and collect Hami. I was able to retrieve 200 from that 400. So the balances now, the balances that remains now is now the exposure to what? To default. Let's use figure. We are going to get them. We are going to get a more clarification on it. So let's briefly look figure from here. All right, this is the first stage of ECQ. We are still going to the third stage. That's the first stage. We have a question. The question is, I'm going to send the question here because it's on Word document. I'm going to send it alongside with the video. Okay, so on day one, all assets are classified as what? As first stage. So let's assume at 1st June 2024, I gave you a loan of 500,000 as a bank. So this is an on-balance sheet items, right? Because there is a figure attached to it now, and it is realizable. So, and it will fall under what? Under stage one. at what? At the reporting date. So let's now assume that I stand as a guarantor for you as well to get a loan of 200,000, which is what? Financial guarantees or a promise to give you what? A loan. I stand as a guarantor for you. The money has not yet crystallized. That is what we call what? Off balance sheet. And another thing is that a financial commitment, that is, this person is going to give you a loan in future. Financial guarantee, he has not given you the loan, but he's just picking you as a guarantor. The money, they've not given you the loan already. And another one, I also commit myself as a bank to give you a loan. All those money, they are not in the balance sheet yet. They are off balance sheet. I can assume I want to be your guarantor. You have not gotten the money. You are still on processes. And also, a bank also what promises you to give you a loan. All those money, they are not really, they are not on the balance sheet. The only one that is on the balance sheet is the 500,000, which is a loan that has been done. Which is a loan that has been done. So, sorry for that. So this is a loan that has been done. So we have on balance sheets and off balance sheets. On balance sheets and off balance sheets. On balance sheet and off balance sheet. The on balance sheet here is 500,000 and the off balance sheet is 200,000 and 100,000. So how are we going to calculate the ECQ based on first stage on this amount? Let's go back. Now, we are choosing telecommunication company that collected this money. Telecommunication company is the one I'm promising to give a loan of 200,000. I'm also promising telecommunication as a guarantor that don't worry when you get where you need me. I've already signed. Go and collect the money. The money has not been corrected. It's a financial guarantee. Then also now they have the one that a bank has already given a loan of 500. So when we have 500, 200, and 100, we have 800. That gives us what? Exposure at default, which is the EAD, which is 800,000. 500,000 for online balance sheet. Then we have the 300,000 for offline balance sheet. Now, I look at it. What is the probability of a telecommunication company defaulting? Here, I use 2%, but sometimes it might be 0%. So when you look at some financial statements, because I said that all categories of loans have to be categorized under the first stage, and you are not seeing any figure. You might not see any figure because sometimes it might be zero. It might be zero probability of default. It depends on the perspective of the lender. It might be 0%, and when we turn it zero, or it can be even 1%, it might be 0.00%. So when we turn 0.0% of the money borrowed, it might return to zero because rounding off figure self will not bring anything out. So here we use 2% on as a probability of default, and we use loss given default as 40%. Loss given default as profit as what? As 40%. That is, I've tried all the means I could. This is the percentage I know that even I use charm, this person will not pay this 40%. You have already looked at it. Even though I use anything, I use Mopo, I use Stout, 40%, this person will not pay. And that is what we call loss given default. So after our calculation, we have the ECQ under the first stage of IFRS 9 to be 6,400. 6,400. So let's have a look very well. $6,400. So how will we record and recognize this 6,400 on the financial statement? How will we record and recognize the 6,400 on the financial statement? Let's take us to the next slide. This is the balance sheet aspect. You can see we have the loan, which is financial assets. You can see less expected credit loss of what? Of 6,400. Then we have the debt loan, which is what? Financial asset of this. So in our balance sheet, this is how we are going to report what we have already calculated. This is the income side. You can see the impairment loss, we record it under expenses because it's a loss to the company. Any ECQ reduces the profits, and that is it. And that is the reason why when you are giving loan, you look at the person you are giving the loan. Because if the person doesn't pay, it reduces your profits. Yeah. Yeah. What you can do is to carry it out. You get a recovery agent. A recovery agent try to manipulate, try to drag and drag. There is no way you can drag some people. You can't collect anything because they've already determined they won't pay this money. So any money you are giving out, just know at the back of your mind that you are lost. So this is the impairment loss on the loan, which is 6,400, which reduces what? The profits. So let's go ahead to look at the gross amount just the same way. How does it impact in the financial statement? Just the same way we did it. You can see the gross amount, which is 800, we less the ECQ, then we get the less loan carrying amount. Then we look at the income. Now, this is the interest income because there is an interest on the loan, which is what? The 6% interest on the loan. The 6% interest on the loan. Any loan you are giving out, you are getting an interest. So when you do the interest of 6%, we have 48,000. And that's why you see interest income then. Then the loss, you have to deduct the loss from here. And that is how you see it on the screen. Okay, so let's quickly move ahead. This is the interest income. Yes, we looked at that. That is the interest income of 6% on the 5 piece on the 800,000. Then we have the 48, which is the interest income less what? Less the impairment loss. Then this is a note to the accounts. The note to the account in the financial report, a real life financial report, you are going to report in details how your loan is being calculated. At least it's a judgmental basis. You are judging it with your perspective of each client, of each customer. So they will tell you, okay, how do you go about it? You tell them the loan is amounting to what? 800% the net expected loss. So after calculating the ECQ, so we resulted the book value is now what? Is now 370. Then we have a calculation for it. The expected credit loss, when you look at the second expected credit loss, you see how it was calculated. You are taking 2% for the first stage. Probability of default is 2%. Then for the first stage, 5% for the second stage, and also the loss given default is 40%, just to explain generally what you have done so far. And that is what notes to the account is all about, telling in details what the financial report is all about. And that is what you have done here, telling them this is what has happened. At the end, that the interest is what? Is 6% on the gross income for a loan of 800,000. Then at the first stage, we have the interest income for the period of 48,000. Then the second one is also 48,000. The revenue primarily comprises of the goods. You tell them this is the streams of revenue. Also operating expenses, this is the, so you tell them particularly what all those notes, all this figure entails and their calculations and breakdown. So let's go ahead. This is a real life financial report This is how it occurs. A real life financial report, a real life financial report. This is a real life financial report. But before this, I want us to see credit losses. How does credit losses being derived at? Because these are credit losses. This has to be, they could have aligned it. Please let me quickly go there. Yes. See, credit losses assessment. See how a company assess its credit losses. The table below provides analysis of banks' internal expected credit loss rate scales from 1 lowest risk to 15 highest risk, and how it corresponds to external rating of this. So when you look at this is how to rate. Everybody has his clients, has his own sense of rating his clients. You can see risk rating. You can see one, they have their own clients. Excellent. This is excellent. That is underrated is AA. So grade of investment. Let's put it in investment. Then this is, they have already what? This is how to analyze them. This is their client rating. They analyze them. After that, they now brought this the internal risk rating category back here to be able to what? To put their figure. After they've already rated there, they've rated this person is doing well. This one is under, let's put it under excellence. No, this one, fair. And this one, weak. So with all what you have done so far, the financials, everything, you could have known. Nobody will help you. Nobody will help you to calculate your ECL. You know your ECL more than any other person. You know your customer more than any other person. So it's your policy to be able to know this is what and what to do. What the standard does is to give you a platform, a template on how to do it. They won't give you the rates. You have the rates, it's judgmental. So you can see this, they've already analyzed this. These ones are doing excellently well. This one, very good. This one, very strong. This one, fair. Weak. This one, don't let us put it. In fact, there are some, they don't even, under weak straight, they don't even need to consider them. And you can see weak, the figure is very high. You can see it's very high because most of this, you don't have to put yourself into more risk by rating customer that you know that you don't even have confidence on. There will be issues. So you could have known your risk even for calculating this. So you could have known that let me put my head. Not that eventually I will not fall victim. No. You can see their weak is very, very high. 1.141, 657. And when you look at excellence, you can see there is no figure. That is what I'm saying. That some might not be 2%, like a telecommunication company, construction companies. There are companies that are doing very well, SMGs and so on. Sectors, all sectors are doing well. So when you look at the percentage of default, it's very low, very, very low. So when you use the percentage, it might not even bring out any figure because it's rounded to billions, it's rounded to trillions. And what it says, you can see this one started from good. You can see the fair. The weak is the most one because people will like, please, for any person that is collecting the mindset is that will this person pay this money back? Now, it will not come that the economic have the dollar rate is high because that is the excuses. For you lending anybody money, I have a hawk who said I can't lend anybody money, the money that I cannot live. He'll tell you, I can't give you the money I cannot live. Because at the back of his mind, he knows that any money he gives out, it's not coming back again. So he will tell you, this money I'm giving, I will give you what I have. Not that you say I borrow you. I'll not be expecting money. I'll be knocking at your door. You'll be cutting off my phone. That one will not happen. If you give me, you give me. If you don't give me, that is it. And that is the reason why banks, before you even step out of they've already categorized everything weak. Because sometimes they might not even have that confidence. They could have said, let me take the risk so that I will know that this thing will eat my P or A before I'm not incurring unnecessary assumptions. So that is it. That is all for the classification of ECQ. This is a real life scenario template from one of the known financial reports. So let's go ahead to look at the second stage. Second stage of ECL. second stage of ECL. So how are we going to calculate ECL on that second stage? Second stage of ECL will also be exposure at what default. Now lifetime probability at default and loss given default. But before that, we need to look at how to categorize second stage. You know, we talk about the first stage, the significance, 12 months, and also gross payments, gross interest analysis. But under the second stage, how are we going to categorize this? Now, if there is no significant increase in credit risk from the first stage of loan to 12 months of period, then the loan will what? We still resorted to what? We still remain in the first stage. What do I mean? You have looked at the telecommunication system. I don't know the reason why I'm using telecommunication. Let me use construction company or use any other company. There are some companies that are doing well, honestly. There's no doubt about that. Pharmaceutical company, there's no doubt about that. So there's some companies that are really doing well, no matter how the economy does not determine the way they operate, no, because they are life-sustaining products. Pharmaceutical drugs, food, all those ones, they are what? Their exposure to risks is minute. So let's just assume a telecommunication company. Now, under the second stage, a telecommunication company will still remain in what? Stage one. The reason is that there is no traces of what? Credit loss. There is no substantial increase in credit loss. The loan will move from what? From stage one. So if there is a significant increase, then the loan will move from what? Stage one to what? To stage two. But if there is no significant increase, it remains in what? Stage one. Hope that is clear. So at this point, the company needs to set aside money to cover entire possible loss for the life of the asset, the financial asset. The reason is different from 12 months expected credit loss. The reason why they have to set what? A percentage to cover what? The lifetime ECQ calculation. Somebody that has defaulted once can defaulted whole. Once defaulted, it is possible that the person will still default. It's just that somebody that comes, they said that this person will not do that again. I'm not sure it will not do that. It's better not to do it at all. And that is how trust comes in. In the moment you breach a trust, there will be issues. So once you defaulted, a lifelong ECQ is calculated based on all the total. Because they don't want stress. IFRS don't want stress. They don't want you to stress yourself. So far, you have already noticed that this person, this one that is giving me that the dollar is high. This one that is telling me that there is no food in the country. He did not pay the first day, he did not pay. Another month, he did not pay the second or fourth month. The next month, I will calculate it on all total, the lifetime of the ECL is calculated based on that amount. No 12 months again, no any percentage, you calculate based on what? On the lifetime. So we are going to get there. And also the interest still remains what? The gross carrying amount. Let's put a figure. So the same thing applies. Just the same scenario we cited the other time. Now we are shifting to the next one. which is what? The second stage. From here, we'll be able to determine our ECL, our PD. So, okay, this is the credit rate. This is just the criteria. Also, the criteria to watch on how to do the second stage. The second stage and the first stage is likely the same thing because you are going to look at your credit rating, the industrial standard, the judgment. You judge your client, just the same stages before you push it to the second stage. So if it doesn't meet all the criteria, you push it to second stage. If it's still intact, you remain it in the first stage. So see the ECQ we calculate. This is the rate in the analysis. So let's look at the calculations here. So now we have looked at the probability of exposures has increased from 2% to 5% because we have seen trade. Because we have seen traces. Because we have seen traces. So we are basing it on the lifetime of what? Of the loan. Now 5% on the lifetime of the loan. Now the same thing, exposure to is still the same, and the exposure, no, loan given default is still the same. Exposure at default is still the same. So we have 16,000 ECL here, and also the interest is still the same, 6% on the gross earnings. So the same thing. Then we calculated it as 800,000 minus 16 give us this, which is now the net carrying amount in the book. Then same thing, the interest income less what? The ECL. So also you also explain, this is how it's gotten. You gotten the loan amounted under the second stage. Under the second stage, the loan amounted to 800,000 represent equal 16, resulting into the book value of 784,000. The expected credit loss for loan was calculated based on PD, LGD, and EAD, where the probability of default is 5%, loss given to is 40%, and all the like. All this will be explained in the notes to the account. So let's briefly look at the way it is, just the way I've explained the other time. You can see under the life ECL, not credit loss impair, you can see under the life, that is the second stage. The life is the second stage. You can see there is no, if you look at the good, you can see 3053. That is, there is no figure in the second stage. It means that this person, this firm is liquid. That is, they pay on time. There is a confidence that they will not default. And that's the reason why I said initially, if there is no traces of default, it remains in stage one. You can see they remain in stage one. Every one of them remain in stage one. 3053 remain in stage one. 827, 702 remain in stage one. And they don't go to stage 2 and 3. The one that started from week, which is 141,657, go to stage 2, of which it's will because there is a lot of figure there. At stage 3, you can see, and on and on and on. You can see the expected credit loss at the end of the day. So that is how it's calculated in real life. As I said, these are based on assumptions since you have already assessed your customer in order to do the network. So let's quickly go ahead. Let's look at the stage 3 before we end this lecture. The stage 3 is a critical stage. It's really, really critical. For a loan to get to this stage, it means that they've already used MOPO. They've used loan recovery agents. You know, a lot of things could have been done, and a stage 3 loan under IFRS 9 represents financial assets that are defaulted. That is, amount that is outstanding. This classification of loan into stage 3 has significant effect in the financial statement because of the high ECQ, which will reduce the profits. So when an ECQ gets to this level, definitely it's reduced the profits. So, and probability of default here is also what? The probability of over the lifetime of the financial asset. For stage 3, you typically have a life time of the probability of default, which is the higher than what? Which is higher than stage 1 and stage 2. Apparently, when you are charging, the percentage will be like 10, 15, or even 20, 25, depends on the judgment. So it has to be higher than stage 1 and stage 2. So we look at credit impaired, that is the default. The default has already occurred, so it's likely to occur. When it gets to this third stage, it means that the default the default has occurred, it's likely to occur. Yes. So there's a kind of red light that in fact, you know that this person will not likely to pay. So for the stage 3 loan, for financial assets, where credit impairment or loss is obvious, the probability of default is typically set high due to what? The significance of the default, as I said. And also, these are the key to determine, let's also look at the key to determine the probability of default under stage 3. Let's look at probability of default under stage 3. Sorry, this is supposed to be stage 3. This is supposed to be stage 3. I'm going to change it in the slide. Please. If I'm going to refer the slide, it's supposed to be stage 3, not stage 2. So you can see that the ECL is 20%. You can see, because you know that the probability of default is now very high, that this person here might not pay. So the loan given default is still 40%, and also the exposure at default is 800. So we look at still the same calculations. You can see now that if the income the payment loss have already surpasses the income, because we know that this person might not pay. So you can see the credit loss is even surpassing the interest on the loan. So that is the red light. That is the risk of lending. So let's look at those two accounts, just the same thing you explained. The loan amount of 800 is represented by the net expected value of this, and resulting to this, resulting to 736,000. ECL calculation, EDP, we have the 20% times 40% of 800,000, which is 64,000. Then we have the interest income on 6%. The interest income on 6% would be calculated, but please, on the third stage, the interest income will be calculated on the net. The interest will be calculated on the net carrying amount. You can see, not on the gross, on the net. That is, you have already deducted the ECQ. You have already deducted the impairment loss. It will be calculated on the ECQ. It will be calculated based on, you can see there is difference here. So it will be calculated on the net, not on the gross as others. So the same real financial also applies. You can see the third stage of ECQ, just the same thing as analyzed here. And in conclusion, let's quickly conclude this. Accounting is not just about numbers, it's about understanding the story behind them. So with IFRS, now we gain the tool to read and interpret the story more clearly. Also transforming complex data into insightful narrative that drives smarter decision and a brighter future. So thank you very much. Thank you all for listening. And we really look forward to bringing more other subjects that are of value to our participants. So under ECL, if we can follow these appropriately, you should be able to determine and calculate your company's ECL as it is due. I know my customer, you know your customer. I can't know your customer more than you do because you are the one who owns their information. You have their data with you. You have the update of their data, even if they are old clients. So you will be able, based on what I have explained today, to determine and to place real value, to place real percentage on their loans. You know what ABC submitted. You know their financial, and that is the reason why anything you are doing with the bank, they will tell you, even individual, they will tell you, go and bring your bank statement. They want it in PDF. They will never want it in Excel because they know Excel can be edited. They want it in fact, some people say, no, don't worry, just give me the link. I want to download it myself because that is where your strength lies. If a bank wants to give you a loan as a salary earner, they will tell you, please bring your bank statements. I want to see the level of how you receive income. I want to see that one will based on what I will give you because they are trying to curtail losses. You have the information of your client. You should be able to place the appropriate percentage of ECQ to calculate ECQ. And based on IFRS 9 with the template that IFRS 9 has already illustrated for us, we should be able to analyze how and when to calculate our probability of default, the loss on default, and exposure to default, to risk. So I really appreciate your efforts, your concern in learning, and also we also look forward to bring all other topics that will be of relevance. So if there is any question after this video, please feel free to get back to us through our email or WhatsApp chat. I'll be there to attend to your question. So thank you all for this, and I hope you'll be able to jot some things out when you receive this video. So I want to use this medium to say a happy new year to us all once again. And then we appreciate us for we appreciate your continuous learning and growth towards your development. So thank you all. And the Questknow Services is wishing you a happy new year and a prosperous new year. Thank you very much.